Welcome to this special webinar on managed funds. We have a fabulous expert with us today who will be introduced shortly. And just to give you a bit of background for those of you less familiar with 10,000 Girl, we're a not-for-profit social enterprise, and our purpose is to improve the financial well-being of Australian women throughout Australia, with a specific focus on reaching regional women and women living in the bush. So our goal is to help 10,000 women around Australia become financially empowered. We've actually reached that, so we're just keeping on. And this webinar is part of a broader series that we've been running over the last couple of years. So all the recordings will be available. If you enjoyed this webinar, there's also other live tutorials that you can access from the website also. Just up front, a bit of a disclaimer, we're not providing financial advice, and we really encourage you to seek independent professional advice before making major financial decisions. What these programs aim is to equip you with the confidence, with great questions to ask, with a sense of engagement and excitement about your financial future. So when you do go and seek advice and seek further information, you can do it in a really engaged and valuable way, and make sure you're getting huge value from those conversations. So we're able to provide these programs for free thanks to our generous partners. Financial Literacy Australia has helped us with this project over the last 2 years. Rabobank we've been working with for over 5 years now, and they are particularly passionate and share our passion about reaching women in regional areas. We also work with the FPA, so the Financial Planning Association. If you are looking for a financial advisor, that's a great place to go to make sure they're registered with their industry body. There's other checks, of course, you need to do as well, but that's a great start. HESTA is an industry super fund. The ATO, even the ATO website, as increasingly valuable and easy and accessible resources if you want to know about super and tax. The Understand Insurance site is about general insurance, and that's run by the Insurance Council of Australia. And on the Credit Savvy site, you can learn a bit more about your credit score. So thanks again to those partners, and a big welcome to our special guest, Greg Hoffman. So Greg's actually joined us for a couple of webinars before. He's a great friend of mine and someone I admire very much and have learned a huge deal from personally. I'll let Greg introduce himself, because I know that he's been kicking goals over the last 12 months or so, and so I don't want to cut him short of his recent achievements. But he brings a wealth of information and is able to provide this in a really succinct and engaging way. So welcome, Greg, and thank you for joining us.
Thank you, Zoe. I hope you haven't set expectations too high with all that. I won't go into too much of my background, but currently I am chairman at Forager Funds Management and also the second largest shareholder in that business. So we manage more than $280 million now on behalf of our clients. But prior to that, I was research director at Intelligent Investor for 10 years, which was a business, or is a business, that provides share market advice to thousands of Australians around the country. I've been in and around the share market for 30 years. I'm only in my late 30s, so I started very, very early. It's a real passion of mine. and I also contribute a monthly column to Money Magazine, which you can find if you pick that up on all good newsstands. Today, Zoe, can we just go to the next slide? I think you've got control of it, not me. Where, just to put this in context, so the 6 steps that 10,000 Girl has to be fabulously empowered, we're really focusing on a subset of that very bottom one, the share market. So last time around, hopefully most of you attended that or watched the recording of the previous webinar. It was a more general overview of the various options we all have to get exposure to the share market. Today is an even more narrow or drilled down section of that, which is managed share funds. So we're going to cover what a managed share fund is, the pros and cons, why fees matter and the types of fees that these funds charge that you need to be aware of. I'm going to look at the different types of managed share funds, the different philosophies that the managers apply in running those funds, and I'll have a few words to say about ethical investing, which is an aspect that some people feel very strongly about, and I'll just touch on some of the issues there, some of the questions you can ask around that if it's an area of interest for you. Then we're going to spend quite a bit of time talking about past performance and then apply as much of what we've talked about to a case study, which hopefully some of you have had a go at. And then I'll talk a little bit about investing in record keeping. We're just going to run a quick poll now. I just want to get a flavour for how many people have attempted that that sort of pre-work. There are a couple of questions that we included in the invite. So if you could just let us know whether you didn't attempt them, did attempt them and had great success, or something in between. I can't see the results in my box though, so
Yeah,
are we getting any?
yeah. So a few people signed up late, so haven't attempted the
Okay.
question. So the majority of people haven't done these, but what we will do is with the recording, we'll also send out the homework. So if you do want to apply some of this to the case study and work through it yourself, you'll be able to use this information to sorry, I'll read. Yeah, right. to learn.
Yeah, that's fine. And the first question, actually, you might even be able to answer on the fly as we go through it. So that won't be a problem. But it just gives me a sense of I won't take up too much time here if most people haven't attempted it in the interactive part around the answers. But I guess we'll give people a quick chance if they have had a go at it. Was there anyone that had attempted or completed, Zoe?
Not that filled in that that poll. If I don't know if people on the phone, if they can use the control panel as it
is. That's fine, but I won't spend too much time on those poll questions. We'll just move through the material. I'll focus more on the material. Okay, so let's keep moving here about recapping what a managed fund is on the next slide. So last time in the sort of high-level overview, we touched on what a managed fund is, but basically it's your investment, your money being pooled together with a whole lot of other investors, and then a professional investment manager or fund manager makes investment decisions on behalf of the entire fund. Generally, these things are structured as a trust, and the important thing to note about that is that any income, say any dividends that have been received throughout the year, or any capital gains that have actually been realised on behalf of the fund, they have to be paid out every year. So at least annually. Some funds pay out twice a year. They pay out their gains and their income. So it's a fairly simple concept. Okay, next slide, please. The pros are that you get instant diversification, even with a small investment. So you can start investing in some of these funds with relatively small amounts, a couple of $1,000, and straight away you're going to get diversification. You're buying into a portfolio of dozens, perhaps more than 100 companies, depending on how the fund invests and how many stocks it owns itself. Whereas if you only had, say, a couple of $1,000 to invest and you were trying to buy those stocks yourself, you probably could only really economically buy one or two stocks with $2,000, and you wouldn't be properly diversified. So you get that instant diversification. The other main pro, I think, is that it's generally easier to keep records than a portfolio of direct share investments. So let's say you had $20,000 to invest and you put it in either a managed fund or you bought 10 shares, put $2,000 in each of 10 shares. Well, if you have those 10 shares, you've got to keep track of all the dividends, all the paperwork for each share, if you've sold any or they have any share issues throughout the year. There's a lot of toing and froing, well, there can be, in owning shares directly. Whereas if you have that 20,000 invested in one fund, you'll get that annual statement for your tax purposes. You'll keep records of when you bought into the fund and when you exit. But it's generally much easier to keep record of just a single investment in one fund than it is 10 different investments in 10 different stocks. So I think that's a pro. The cons are that the fees can be high. We'll talk a lot more about fees in a second. You have no direct control over your own investments. So this might be a drawback for any number of reasons. One might be tax reasons. If you've had a year, maybe you had some time off in a certain year, so your income was low. If you had your own investments and you had some investments that had large capital gains, you may choose to realise those gains in a year where you had less income. Or if you knew that the following year you were going to take some time off, then you might choose to sell some stocks in that year. You can kind of tailor your own buying and selling a little bit around your own, say, tax needs. For instance, there's also control issues around ethics, which we'll talk a bit more on later. Perhaps you have some strong feelings about certain companies or industries. Obviously, with a managed fund making the decisions on your behalf, you can't control that. And just a small but potentially important point is that in extreme market conditions, so for example, the global financial crisis, funds can go into what they call lockup. So that means you can't get your money back for a certain period of time. Generally, that's not the case with the bigger investment funds, but certainly a fund that is investing in smaller stocks where they may not be able to sell those stocks very easily. They can sometimes go into what they call lockup, where you just can't access your investment for several months. So 99% of the time that's not an issue, but it's just something to keep in the back of your mind. Another reason perhaps why smaller funds investing in smaller stocks can give you higher rewards, but also carry higher risks, and that's one of them.
Great. It sort of reminds me of politics, doesn't it? That you vote for a party, but you don't have total say over the policies.
That's a great analogy. Okay, so we'll try and do this sort of pre-coursework on the fly here. So the setup for these next two questions is, in a world of low interest rates, imagine that the share market will return 6% per year over the next decade, and that most large share funds will simply match that figure before taking their fees. So the first question is, what proportion of your returns will a manager charging an annual fee of 1% be taking? Okay, so we're assuming that the fund makes 6% per year in line with the share market before the fund manager takes their fee. So have a go at which option you think there, if the fund manager's taking 1% fee.
It's all anonymous, so just give it a crack, and we'll talk more about why this is soon.
Yep.
Okay, votes are coming in. So pop your vote in, A, B, C, or D. People are having a good think about it. It's great.
What do you think, Zoe?
Well, that could be awkward, couldn't it? I did have a think about this before, and I think I overthought it so much that my initial thought was B, and then I was like, oh no, I'm thinking too much, la la la.
Okay, so what is the most popular answer? Here we go. Okay, so B is the most popular answer, and that is correct. So well done to the B people. It's fairly simple in terms of the return is going to be 6%, but then the manager is going to take 1% of that 6%. So 1/6, or if you're into percentages, you could do 1 divided by 6, which will get you to 16.67%, which is quite a large proportion of your return. So in a low return world, say 6% out of the share market, which I think is quite a reasonable assumption given that interest rates are down at sort of the 2% mark. That a fund manager taking 1% a year of your returns is taking 1/6 of your returns. So the next one is very similar, same set of facts. We're assuming that the market's returning 6% a year, but this time we're looking at investing in a fund that's taking a 2% fee. So what percentage or what proportion of your returns will a fund manager or a fund that's charging you a 2% fee be taking if you're getting 6%?
It's so interesting, isn't it? Because when you think, oh, 1 or 2%, 1 or 2% in any context sounds small, doesn't it? But when you really work it out, it's so vital to actually do the maths behind it, isn't it?
Exactly. And people, I think for that reason that you say, Zoe, it doesn't sound like much. Oh, 1%, 1.5%, 2%. They don't sound like big differences, but when you're talking about taking 1 or 2% out of a return of 6 or 7%, there we go. Everybody's got it right. Terrific. So that hopefully just underscores the importance of those fees, especially in a low return world. We really want to keep those fees as low as possible. Now, moving on to this next dot point, there's 2 broad buckets of funds. So the first is passive funds. So these are funds that they're not trying to beat the market. They're actually just trying to copy the market, to replicate the market and give you as close to that market return as possible. There are obviously some costs in running them, and we'll talk about what they might be on the next slide in a second, but they're trying to keep costs super low and just match that index. There's no chance that you'll do better than the market in those funds, but there's also no chance that you'll do way worse than the market. So they're just trying to get as close to that market return as they can, less their relatively small fees. An active manager is one that will market to you about how great they are, how much research they're doing, how smart they are, how they can pick stocks or trends better than everybody else. They'll be charging you higher fees for it, but their sales pitch will be that they're so clever and they're so experienced that they can outperform the market even after taking out a relatively large fee, at least compared to the passive investors. So for that's sort of the broad choice. There's a lot of research that leans the way of passive investing that says, look, taken as a whole, all of those active fund managers, they virtually don't, or they never beat the market over a long period of time as a group. Of course, there's individual fund managers who do well and who do well in any particular year, but as a group over a long period of time, when you take out their fees, they do not beat the market and they do not beat passive funds. So you might make a decision and say, well, okay, that's a pretty powerful insight. I'm happy to just think about a passive fund or an index fund, and that way I don't even have to worry about a lot of the issues that we're about to talk about. And that's a perfectly sound, rational approach to take. Most of what we're going to talk about here is around trying to select an active fund and things to watch out for and look at there. So one problem is what we call in the industry index hugging. So this is basically where you're investing in an active fund, but you're really just getting a passive fund. You're really just getting an index fund, but with active fund fees. So how in the world can you tell whether you're dealing with an index hugger? A couple of points to make. One is that Australia's share market is dominated by the big four banks. So about 23% of our market is in those big four banks. Then the two resource giants, they make up 12% of the market. Then Telstra is 4%, and then Wesfarmers and CSL are 3% each. So if we add all that up, we get something like 45% of the market in just those 9 stocks. You can see, for the more visually minded, there's a word cloud there at the bottom of the page that kind of visually shows you that that relative size balance. You can see it's dominated there by the big banks, BHP, Telstra, CSL, Wesfarmers. And what that means is, if you're looking at an active fund, a fund that's telling you that they're going to outperform the market and that they're very clever in picking stocks, but you find that their top 5 holdings are basically the big 4 banks and maybe BHP or something along those lines, chances are it's probably just copying the index anyway, and that it will struggle to beat the market after fees. So it's just one way to look at a fund. You should always sort of have a quick look over their top 10 holdings, and if you find that they're just fairly representative of the market, yet they're charging you quite a high fee, you might want to look elsewhere. So let's have a look at what a high fee might be.
Yeah, is it worthwhile, Greg? Before we, okay, no, you're onto it. I was just about to say, sort of looking at what some of the index funds versus some of the active fund fees are.
Yep, exactly. So when we talk about the types of fees, the first is a management or a base fee. So that's charged regardless of how the fund performs. And it can vary greatly from the lowest cost funds, which are generally those passive or index funds, which can be as low as 0.25 or even lower in some cases for very large passive funds, up to some active funds I've seen charging 2% per year. And that's just the base fee, regardless of whether they make money or lose money for you. Just a small extra side issue there is fund expenses, or the jargon is recoverable costs. So there are some of the costs, like they might incur legal costs or registry costs. So when you first invest in the fund, or when you redeem your investment, a registry keeps track of who actually owns the fund at any one time. So there's costs involved in that. So they may be included in that management fee, or they may not. It's something to look for. So what you're trying to figure out is really, what is that total ongoing fee that I'm paying, and are those fund expenses taken up in the management fee, or are they on top of it? The third can be very, very significant or non-existent. So in passive funds, a performance fee is non-existent. They don't charge a performance fee because they're not trying to outperform the market. A performance fee is paid to a fund manager when they do better than their benchmark. So they will set up some kind of yardstick for them to be measured against. Typically, it's the ASX All Ordinaries Index, or the ASX S&P 200 Index, which are very close to being the same thing. And if the fund manager does better than that index after they're charging their base fee, they'll get an extra fee on top of that. Sometimes that can be very, very significant. Some funds don't even look at the stock market index. I've seen some funds that charge a performance fee if they do better than the RBA cash rate, which just seems crazy to me. You're talking about investing in a shares fund that has quite a high amount of risk, certainly relative to a term deposit, which they're effectively measuring themselves against. So have a look at what the benchmark is. If there is a performance fee, ask yourself, hang on, is that sensible? Are they just taking the mickey a bit here, or have they really set themselves some kind of sensible benchmark to perform against? And then the final point is just to be aware of little hidden costs. So they won't be up in lights, but there are obviously costs as the fund manager buys and sells stocks. They'll pay brokerage on behalf of the fund, which is a cost to us investors. And the other aspect is that the industry presents all of its returns on a pre-tax basis. Now, if you've got a fund that is trading in and out all the time and making short-term capital gains over weeks or months, and they do make a 10% return for the year, and you have another fund that is a very long-term investor that hasn't actually realised any capital gains in the year, and they return 10%, by the time you run that through your tax return, you'll actually end up better off in the fund that was a long-term fund than the one in the short term, even though they both might report a 10% return for the year. So you want to understand a little bit about how frenetically the fund manager is trading the portfolio, because that can really impact your after-tax returns, even though the pre-tax returns that they put up in lights might look attractive or the same. So these are just aspects to sort of put on your checklist.
That's great, Greg. Thank you. And if anyone's got any questions along the way, feel free to put them in the question box, and we'll incorporate them into the conversation as we go.
Now we're going to move to the types of managed share funds. So you might find funds that are focused on large companies or blue chip stocks, like the Perpetual Industrial Shares Fund that we're going to come to a bit later on. You might find a fund that is really focused on small companies, or one that's focused on mid-sized or what they call growth companies, which have been very popular the past few months in particular. Also popular over the past few years as interest rates have gone down and down are income funds, share funds that are focused on stocks that pay big and hopefully stable or increasing dividends. And then there's also international funds that invest in shares overseas, or some mixture of Australian shares and overseas shares. So that's another decision for us to make as investors about, okay, what do I want to be invested in here? And there's no necessarily right or wrong answer. You know, small companies tend to have higher risk, higher return characteristics. So when things are going well, as they have done for a lot of small companies over the past couple of years, they look terrific and you wish you had all your money in them. And then when there's a market downturn, they're often the ones that suffer far worse than the blue chips. So you wish you had all your money in blue chips in the downturn. So there's no right or wrong answer all the time, and part of it is what you're comfortable with, how much risk and volatility you're comfortable with. So generally the smaller stocks are going to be more risky and more volatile. The larger ones are generally going to be safer and less volatile. Though it should be said, you know, shares in general are quite volatile. Within the market, the larger companies tend to be more stable than the smaller ones.
And there's a lesson in that about diversification, isn't there? And making sure that whatever you choose next complements the rest of your portfolio, whether it's in just shares or other asset classes, isn't it?
Exactly right. So, for instance, if you, perhaps you inherited, a portfolio of 10 shares that were all big blue chip shares. A grandparent had or a parent had passed down a portfolio that was a few of the banks and Telstra and Woolworths, AMP, all of these stocks that they'd accumulated over the years. If you were looking to add a managed fund to that, you might look at something that was more small size or growth companies rather than doubling up on those blue chips, for instance. So it's just a matter of looking at your own situation and what you're comfortable with.
Great.
The other thing, or another thing to look at or consider, is the investment approach or the investment philosophy of the fund manager. And again, we're just talking about active fund managers. So those passive funds don't have a philosophy. All they're trying to do is meet the market. We're just talking here about active funds trying to beat the market. Some fund managers take the approach that they want to be invested in growth stocks. They want to be invested in companies that are growing their profits and in fast-growing industries, or for some reason are able to, because of superior products or superior management, able to grow within a slower-growing industry. That sounds good, and it can work very, very well in the right market conditions. The problem is that sometimes those stocks get overpriced. So if you actually look at a long-term chart of something like a Harvey Norman, it became a very a much-loved growth stock in the late 90s and just absolutely went through the roof. And then it took a while for the actual business to catch up to the share price, and I think the share price went sideways for 10 years, down or sideways for 10 years, even though the profits continued to grow, because investors had already factored in so much growth in the late 90s, which actually did come true. They just paid too much for it. So that's the risk, and that's what the value investors or the value managers focus on. They start with the price typically, and they want to buy stocks that are cheap for what they're getting. So they'll buy into businesses where maybe profits are shrinking or that aren't even profitable at the moment. They might be in turnaround phase, but they might have a lot of attractive assets, and they'll tend to buy those and wait for the turnaround, or if they're bought cheaply enough, there might still be great returns in even a story that's not so attractive. So they're the two kind of main camps in the active investing world. The value investors who are really focused on picking up bargains, or the growth investors who want to identify great stories and run with them. Some managers are in between, a blend of the two. And you can see in the box there that in the bottom half of that slide, we have what's called a style box or a style matrix. So across the horizontal axis, we have the fund manager's philosophy, whether they're a value investor or a blend of value and growth, or a growth investor. And then on the vertical, or the y-axis is the size of the stocks that they're buying. So are they buying small, medium, or large cap stocks? As a general comment, I would say the box where the X is, which is a fund manager who's focusing on small companies and their growth companies, that is probably the highest risk, highest potential reward place to be. And the diametrically opposed, the value investor focused on larger stocks, is probably the lower risk, potentially lower return box on that style matrix. So again, it depends on what you're looking for, but it's just another way when you're comparing funds to think about some of the aspects that you should consider. Now, the third point doesn't really fit into the investment philosophy the same way, but it's a different dimension, and that is the ethical funds, which some people feel very, very strongly about. The two broad approaches that the industry takes to ethical investing are what's known as a positive screen or a negative screen. So a negative screen is the fund manager will sit there with a list of, let's say they're only focusing on Australia, all the stocks that they can buy in Australia, and then they'll say, okay, there are certain companies or industries here that we want to screen out based on the fact that we don't think they're ethical. So that might include any companies making weaponry, firearms, that kind of thing. Might include certain extractive industries, coal mining. It might include poker machines. Yeah, some people feel the poker machines aren't ethical, or gambling stocks in general aren't ethical, in which case you can get into some nuances. So for instance, Woolworths is one of the largest owners of poker machines in Australia. So should an ethical fund manager with a negative screen be screening out Woolworths? Perhaps. It has bigger businesses, but it is an important business for them. The other process is known as a positive screen, which in some ways is a higher hurdle. So they start with no stocks on their list of potential investments, and then they say, which are the stocks or industries that we think are doing positive things for the world? And then they'll just start adding stocks to their list of potential investments. So you can see that's in some ways a tougher approach, a more restrictive approach for the fund manager to have that positive screen. So they're the two broad approaches. So if you're thinking about ethical funds, have a look through the various marketing material and the product disclosure statement and see whether it's a positive screen or a negative screen, and have a look at the industries that they're screening in or out, or the companies they're screening in or out, and see if that gels with your view, if this is an important aspect for you. It should be said that there is no hard and fast definition of ethical. So some people feel when they see ethical, they'll superimpose the word environmental onto it. It's the environmental aspect that's most important. Other people have more of a social focus, or maybe it's both. But you need to make sure that the funds you're investing in, as I said, sort of agree with your particular view. And it can get very, very complex very, very quickly. So for instance, we used to run a model portfolio at Intelligent Investor, a model ethical portfolio. One of the stocks we held for a long time in that portfolio was Cochlear, which makes bionic ear implants for the profoundly deaf. and that is a product that transforms people's lives. It's a wonderful, wonderful product. But we were criticised at times over the years by people saying they didn't believe that Cochlear was an ethical company because while the product is a great one that transforms people's lives, it costs them a couple of $1,000s to make, and they sell it for tens of thousands of dollars. They make a huge profit margin on these products, and they felt that that wasn't an ethical approach to business. So again, there's another aspect of ethical investing. So it gets very, very complex very, very quickly, and I hope that's just given you a flavour for some of the issues and why it's not a particularly easy area to wade into. But if it is something that you feel strongly about, hopefully that gives you a few thought starters there when you're comparing different ethical funds.
And the industry body for responsible investing, so RIAA or responsibleinvestment.org has some good resources to help you understand those different grey areas of ethical investing, and has a good annual benchmark report that lists some of the big ethical managed funds and super funds if you're interested in that.
Mm-hmm. Moving right along. Okay, so past performance, which is really the main thing most people tend to focus on, and it's hard not to focus on it because there's so much data available about it. But a few important points to consider on this. The first is just a general point. This is not like comparing term deposit rates or credit card rates or mortgage rates. With those kind of products, as long as I've adjusted for all the various fees, hidden fees and everything, as long as I'm comparing apples with apples, I can just go with the best deposit rate or the lowest credit card or mortgage rate. There's really not much to it. But when it comes to funds, the little asterisk that is always there, that is past performance is no guarantee of future returns, is so, so important. Every time you see it in your mind, you should bold and underline it. Because it's the truth, and there's some evidence, quite a lot of evidence, to say that the best performing funds of last year are often, if not the worst performing funds, weaker funds over the following years for various reasons, one of which I'll return to in a second. So this is not like an ongoing rate of return that the fund can guarantee at all. You really need to understand the conditions that it was achieved under, that those past returns were achieved under, and have a think about whether those conditions are going to persist into the future. So that's what these next few questions are designed to explore. So the first is, how long is the track record? If you're just looking at the hot fund from last year, well, that's probably not telling you much. But the longer the track record goes, potentially the more you're learning about the fund and the fund manager. Even going back, say 5 years now, which might seem like a long time, that only takes us back to 2011. So that doesn't include that GFC period. Even going back 7 years only takes us back to late 2009, which was after the worst of the GFC. So we really need to be looking at a 10-year track record if we want to see how the fund or fund manager went through that GFC period. Not saying that all good fund managers went through the GFC, but it's just I'd rather see a record through that period than not, because then I can see how they performed through that really tough time. The other important thing, which comes back to the point I raised before, is how has the size of the fund changed over the past 3, 5 or 10 years? And we're going to see this when we go into more detail on the Perpetual Industrial Shares Fund. But a lot of funds perform very well when they're small. And when I say small, rough guide would be $100 or $200 million is considered small in the funds management industry. At that size, the fund manager has a lot of stocks they can choose from. If you're running a $100 million fund and you want to put 5% of the fund into a stock, that would be a $5 million investment. Well, there's a lot of companies on the stock market that you can invest $5 million into. But what if you're running a bigger fund? What if you're running something like this Perpetual Industrial Shares Fund, which we'll look at? It's a $2 billion fund. So if you're the fund manager and you want to invest 5% of your fund and you're running $2 billion, we're talking about a $100 million investment. Well, there's not very many companies on the stock market that you can invest $100 million in. There might be 50 of them, maybe 70 or 80 at the most. So they're very restricted in their choices when they get to that larger size. So a lot of fund managers that did well when they were running 100 or 200 million, and then everybody says, wow, this fund manager's great, and they put their money behind them, and suddenly the fund manager's running a $1 or $2 billion fund, their returns often fall because instead of being able to invest in a choice of maybe 400 or 500 stocks, now they're limited to 50 or 60 stocks. And obviously that gives them a lot less flexibility to do well. So that's one of the questions I would be looking at any fund is, has the size of this fund really changed over the past 3, 5 or 10 years where I'm considering this track record? Something that probably a lot of investors don't think to ask, but hugely, hugely important. The bigger the fund, the harder it is to perform well. The fourth is, has the fund manager themselves changed over the past 3, 5 or 10 years? And if so, how many times? You know, is this the same manager that put this track record together, or did the fund manager change halfway through, or did the fund manager change in the past 12 months? How stable is the fund manager? Is it a company that's changing if it's, say, an AMP fund or a perpetual fund or an MLC or a colonial? These companies have teams of fund managers, and sometimes they rotate them around. You just want to get a sense of how stable is that team, because we're trying to make assumptions about that track record being continued into the future. So if the fund manager is changing every couple of years, that might be more difficult to ascertain. The next few questions are about the way the fund is run. So you should find, maybe not in the glossiest high-level brochure, but certainly in the more detailed PDS or product disclosure statement, you should find out whether the fund is investing in some of these, what Warren Buffett has called potentially weapons of financial mass destruction. So futures, options, these kinds of things. Is the fund using those? Is the fund using leverage, that is borrowed money, or can the fund do that? Does the fund short sell stocks, that is sell stocks that it doesn't own in the hope of buying them back later? That strategy can be profitable in a falling market, but in a rising market, the losses can be very, very high. And if it's an international fund, how does it deal with that foreign currency issue if it's investing abroad? So these are just some of the different aspects that you can consider about the risk of a fund. And you might find, say that a fund does use leverage. Let's say that a fund is able to borrow 20 or 30% of its assets. That's been terrific over the past few years while markets have been very kind, but it's going to work the other way the next time we hit a bear market. It'll exacerbate the negative returns. So just asking those questions up front rather than being caught out and surprised when market conditions change. Okay, next slide. So the theory and the practice, the Perpetual Industrial Share Fund. So I don't even know if it's worth running the polls then if we haven't had.
Well, we might run them, because instead of thinking about perpetual, because for a lot of people you'll be listening to the recording, and so you may have done this, and so it's a great thought process to go through. But even if it's not the perpetual share fund, where do you typically go to research, say, a managed fund?
Yeah, where would you go? What would you do? Have a click. People can have a click.
So when we say perpetual website, obviously like the fund website, whatever fund you're investigating.
Yeah.
Votes are coming in.
So you can click more than one.
Okay.
Okay, what have we got?
Okay, so a good variety.
Yeah, okay. So a lot of people, most popular answer was a comparison website, CanStar. So just let me say a couple of words about that, because if that is your instinct. I use those comparison sites myself for the kind of products that I mentioned a couple of slides ago, like a term deposit or a credit card or a mortgage, where you're really comparing just rates that are being promised to you in the future. the problem with comparing fund or managed funds, as I've said, is that the rates you're going to get in the future are not set in stone. They're not guaranteed. They're going to be determined by how the fund manager performs and the conditions of the market. So CanStar or anyone else can't know what those are. They have their own rating systems. CanStar has a star rating system, but let's say you're comparing two funds and one's got a 4-star rating and one's got a 5-star rating. I mean, you need to understand what their methodology is, the various factors they've considered. I think you're better off focusing more on your own research, hopefully with this kind of framework and these issues that we're highlighting through this webinar, because just trusting a comparison website in this, I would say it's certainly not enough to make a final investment decision on. It might, maybe you could start there if you're looking for a good fund and just look at their 4 or 5-star funds and then go and do your own research directly at the fund manager's website or through Google. But I certainly wouldn't just totally rely on those comparison websites in the same way that I might rely on them with a term deposit or a credit card or a mortgage rate, where it's very easily comparable. Okay, great. Thanks for those responses. Now, the next one is, I think, probably not worth running, or the next two, which are 3 good and bad points, which if people haven't looked at these funds, I don't think there's any point, Zoe, in going through those.
Unless you want me to just flash them up and so you can see some of the different characteristics that you might
that's okay. Let's do that. So pop those up, because some of the responses that we've given are things where you might that you might consider good aspects. You know, perhaps you think that the investment performance has been good, or that it's a large fund, or long established, or both. That the website's user friendly, that there's a low minimum investment, that the fees are low. They're all, you know, sort of important factors to throw into the mix that you should be looking for in your research. Other things might be that the fund manager has been in charge for a long time, or the investment team's been very stable if they've produced good returns, for instance. The next one is negative points. So they might include poor investment performance, high fees, information being hard to find, the portfolio of the fund being too concentrated, or gosh, any number of negative points. Perhaps there's a lot of turnover in that investment team, or the fund manager's changed a lot, or you can't find out who the fund manager is. Perhaps they trade the portfolio a lot, and for the reason that I mentioned before about those returns coming down to you as an investor and going through your own tax return, a fund manager that is trading a lot and realising short-term capital gains is going to be worse for you once you pay tax than a fund manager that has a more long-term, low turnover approach. And just to give you a yardstick for those sort of taking notes, I would say portfolio turnover, many funds report it, something less than 30% I would say is low turnover. That's average holding a stock for 3 years. Anything more than sort of 50 or 60% is getting pretty high. So that's just a couple of little sort of broad yardsticks to look at, whether you're dealing with a short-term trading type fund or a longer-term investing type fund. Okay, D is any information that you wanted to know but couldn't find out if you're researching the fund. That was another poll we were going to look at, but I've got some responses to that, so we won't bother running that poll. And then the last one was, how likely would you be to invest in it? So here are my responses to investing in this fund. So my approach to researching was, I started with Google, which led me to the Perpetual website. I then downloaded the fund profile and fact sheet, which were dated August. I read through those, and then I also read the product disclosure statement, which is sort of the main disclosure document that you look at to invest in any fund that you have to have read before you invest in it, and generally comes attached to the application form as well. So I didn't look at, well, I did look at CanStar just for the sake of looking at it, but I wouldn't look at CanStar typically. Maybe I'd go and have a quick look and found, if I thought I was dealing with a good fund and I went to CanStar and they rated it 1 or 2 stars, then I might worry that I've missed something. So maybe I'd use it as a second opinion, say, something in that kind of case. The three good points that I thought, or the three best points that I could say about this Perpetual Industrial Shares Fund, which has been around a long time. I think it was established in the early 70s. So it's long established. That gives me some comfort that they've got systems and processes that have worked, you know, through the 1987 stock market crash and the various meltdowns we've had. You know, this fund has persisted and survived. The fact that it's a larger fund, a $2 billion odd fund, provides a bit of comfort. And when I look at the list of stocks, it's not a total index hugger. I think its top five, its top holding is Woolworths, which is, you know, a large stock, but it's not one of the big four banks. But I think the next four largest holdings are the big four banks. So it's not a total index hugger, but it is sort of concentrated in those top stocks. I think, for me, the fees are high. So it's about a 1%, a 0.99% fee per year. And when we look at their index, their performance against the index, they have underperformed over 1, 2, 3, 4, 5, and 7 years. We'll delve into that in a little more detail on the next slide, but they've got a very high concentration in banks and financials. So their top 10 holdings include all four big banks, which a lot of big funds do, but also AMP, Suncorp, and QBE. So if something happened, if we had another financial crisis or something happened in financial markets, this portfolio is going to be really, really impacted by that. So that was sort of an exclamation point for me, how much of the fund was invested in all of those financial stocks. So again, that doesn't take much research. I'm just looking at the top 10 holdings and just using a bit of common sense. Wow, we've got 4 big banks and 3 other financial stocks. That's a lot of exposure to financials. The next one is who is the fund, information that I couldn't find out. I couldn't find out on the sort of hour I spent looking at this fund, actually who the fund manager was, how long they'd been running it. I couldn't find the portfolio turnover, and I couldn't find how the fund size has changed over time. So if I had more time, I'd probably, you know, have a bit deeper look on their website, and if I couldn't find that information, I'd probably send an email and say, I've got a few questions, and you'd probably get a response from a company like Perpetual, hopefully answering all of those questions. Don't be afraid to reach out to these companies and put your questions to them. And then just my own personal opinion, if I were looking for an Australian shares fund, how likely would I be on a scale from 1, very unlikely, to 5, very likely to invest in the fund? I would say 2. I think there's worse funds out there, probably ones that are charging even higher fees and hugging the index more tightly perhaps, but there's also plenty of funds that have got a more attractive fee structure, or to me a less concentrated portfolio than this fund.
So for those of you who didn't have a chance to look over the case study fund, or if you're listening to the recording, you might like to use this information and go back and do that and apply this thinking to either the case study fund that we've picked out, or a few other funds, and do some analysis like this.
Definitely. So this is just to make a few of these points. So there's a lovely chart. As I said, I think the fund was founded back in the 70s. This chart only shows from 1996. But the chart shows the fund well ahead of the benchmark since its inception. And at the same time, we can see from the table on the right-hand side, you can see that the fund is below the benchmark. So that 1-year return, the fund gave 6.86%, and the benchmark gave 10.54%. So the fund was 3 percentage points there below the index over 1 year. It was below the index over 2, 3, 4, 5, even 7 years, where the benchmark did 10.84. That's the market basically, and then the fund only did 10%. So it was almost a percentage point behind, which coincidentally is close to the fees they're charging, 0.99%. So they probably, like our sort of theoretical example earlier in the webinar, they probably achieved close to the market return before their fees, and then once you subtract their fees, down they came. 10 years, they're slightly ahead of the market, almost 0.5% ahead, and from inception, they're actually 1.22% per year ahead. So perhaps that comes back to the point I said before, that in its early years, this fund did really, really well when it was perhaps a smaller fund. And over the past 7 years, it's really fallen behind the index, perhaps as a result of getting bigger and being more restricted in the stocks it can cover. So this might be actually a good practical case study in why it's important to look at how the size of the fund has changed. So they show you that great graph, which makes you think they're well ahead of the market, but basically all of that outperformance came more than 7 years ago. Over the past 7 years, it's actually narrowed. The reason it looks quite dramatic on that chart, I don't want to get too technical here, but again, this is another good little point to look out for and to consider, is if you look at the y-axis, the vertical axis on that left-hand chart, you'll see it just goes up in the same dollar increments, 10,000, 20, 30, 40, 50, 60. And what that means is that the difference between 10,000 and 20,000, which is a doubling, looks a lot smaller than the difference between 40,000 and 80,000, which is actually the same proportion, a doubling. Usually when we try and compare charts that go for long periods of time like this one, we use what's called a semi-logarithmic chart, which shows the same percentage changes on the same scale. So this one just exacerbates a small advantage, a relatively modest advantage over the benchmark, that 1.22% a year, which is good, but not astounding Warren Buffett style returns. But when you put it on a chart like that that's equally spaced, it makes it look quite impressive. Okay, next slide. Yeah. So just a little bit on how you invest in these funds and record keeping. So most of these funds that aren't listed on the stock exchange, you'll get a product disclosure statement, a PDS, and that'll have an application form in it. Obviously check the minimum amount and make sure that the amount you're considering investing is more than the minimum. And also have a look at the redemption frequency. So if you do need your money back, when can you redeem your units? That's sort of the lingo for selling. Technically, you're redeeming units. Basically, the fund will cancel the units you own and send you back the cash. Some funds allow that daily, some weekly, some monthly. So just check how often you can get your money back, that redemption frequency. Make sure in your record keeping that you note your purchase or your application price when that's notified. Usually with these things, you apply for a certain dollar amount. So you'll apply to invest $5,000 and they'll respond to you and say, okay, for your $5,000, you received 2,000 units or 1,500 units or 1,000 units or whatever the figure is. Then obviously if you sell or redeem, note your redemption price. All of that will play into your tax return. And in the meantime, while you're holding it, you're going to get annual distributions from the fund telling you, okay, we've collected and paid you out this many dividends or realised capital gains. So you have the option to reinvest those distributions, but you'll still be taxed on them. That's an important point to note. So for your tax return, even if you're reinvesting those distributions, you still have to hold on to that distribution statement and give it to your accountant or put in all of the relevant amounts if you're doing your tax return yourself. So very important to note that purchase or application price, keep those distribution statements while you stay invested, and note the sale or redemption price. And I guess just one more technicality, if you are reinvesting the distributions every year, if you've ticked that box, then you're going to have to note the price that you're reinvesting at every year from a tax point of view as well. So just keep track of your applications or your purchases, hold on to those distribution statements, and they'll form part of your tax return every year, and then the sale or redemption price in the year that you sell will be matched up against your purchase or application price. Your accountant, if you get an accountant to do your tax return, should handle it all. You just need to make sure you've got all the information to give them. So they're the things you need to note. So in summary, I think we've got our summary slide next. The broad point is to know what the fund is investing in. Is it investing in large stocks, small stocks? Has it got futures, options, all of those kind of things? Understand the risks. As I noted with that perpetual industrial shares fund, heavily invested in financial stocks there. It's not necessarily wrong, but it does mean that there's a heavy risk aspect there if something goes wrong in financial markets. Know who's managing the fund and how they're doing it, what's their philosophy, what's their approach. Are they growth managers, value managers? Are they trading in and out all the time, or are they long-term holders? And really importantly, know what the fees are. And if they're high fees, really ask yourself, why do I have special confidence that this manager can perform well enough to justify charging me a high fee? Because most managers don't, and especially in a world of lower overall returns. I mean, I think when you looked at that previous slide, the 10-year return from the market and that perpetual fund was in the 6 to 7% range, which was pretty close to that example, the sort of theoretical example I gave before. So really think about those fees, particularly in a world of low returns, because they're going to take a big proportion of your returns. So we've covered a lot of ground there, but I hope if you are interested in managed funds that it really has given you a bit more insight. We've really dug into all the important issues here, and hopefully you can listen to this again if there's anything you're stuck on, or we can recommend some other books or resources if you're interested in learning more. But happy to take a couple of questions if there are any. I can't see them, Zoe, so you'll have to read them if there are any, or you could email them after if you're too shy to ask them in front of anyone.
Yeah, great. So just before we take the questions, there are a couple of questions that have come through. Thank you very much, Greg, for sharing your expertise and insights and for giving us that guidance. And for everyone, the recording will be available in the next couple of days, along with some other resources and that sort of case study homework if you'd like to work through that example alone or along with this recording to review. So thank you again very much for joining us and for your participation. There's a lot of thank yous coming through, Greg, and I'm going to wrap up the recording now and then take a few questions. So thanks again all, and happy investing.